And to our main conversation for today, Nigeria's central bank says banks recorded 1.3 trillion naira non-performing loans as of November 2021, with non-performing loan ratio printing at 5.4%. That's above the CBN's regulatory requirement of 5%. On capital adequacy, CAR for the banking industry remains above 15%, which shows sustained resilience of the banking system. On the program today, of course, we begin our countdown to the end of the year with a review of some developments in the economic space. Our focus on the show today now is the non-performing loans in the banking system and how it can be minimized going into the new year. And joining me to discuss this is a financial and management consultant and the CEO of Flame Academy and Consulting, Mr. Oji Udemezui. Good morning, Mr. Udemezui, all the way from Nairobi. Good morning.
Yeah, well, it's afternoon here from Nairobi, and I'm very happy to join you in this program.
Well,
good morning to you in Nigeria. Good afternoon, Nairobi.
Great. Well, non-performing loans has been consistently above the prudential benchmark of 5% for some months now. What's your view?
All right. I think looking at the historical trend, you can actually say that it's getting better now. If you recall, sometime in 2016, when Nigeria went into a deep recession, economic recession, before the COVID-induced recession just came upon us, the banking industry got to a point where non-performing loans climbed to almost 15%, triple what the regulatory benchmark should be. And in fact, some banks individually hit as high as 25–30% non-performing loan. Mind you, this is the total volume of loans that have challenges. You know, loans being contract agreements, they have particular patterns in which they are meant to be repaid. So whenever repayment ceases to follow the pattern, the loan is said to be delinquent or non-performing. And all the aggregate amount of non-performing loans, divided over the total loan book gives you a ratio. And because in banking, there is very small room for error. Looking at the fact that banks are highly leveraged in their business model, where they use maybe, let's say, about 100 million money provided by the owners, that's capital, they can lend as much as 1 trillion, leveraging on deposits bought by customers. Whereby, if even just 10% of the loan book goes bad and is provided for, you'll find that the bank's capital will be wiped off, license withdrawn. So the regulatory minimum is 5%. That is, banks must not have an NPL ratio above 5%. Otherwise, there will be danger in the industry. But looking at the trend from 2016, it has been coming down. Sometime 2 years ago, it was about 9%. Then it came down further to about 6.4 last year. But COVID came upon us in 2020. And COVID is meant to impact the economy negatively, with several businesses struggling to pay their loans. So to see in the midst of COVID, the NPL trending downwards from about 6.4 June 2020 to about 5.7 in June 2021 is a good development. So I must commend the central bank and of course the bank's executive management for this effort. Even though I must remark that there's also some danger awaiting the industry because of the central bank's forbearance arrangement, proactive forbearance for banks to give more room for customers to pay their loan based on COVID issues. We have a lot of, will I say, clients in the industry who are in coma, but they are administered, a coma to enable the economic recovery before they can pay. The banks have to be very proactive in ensuring that these COVID-induced bank loan delinquency are resolved. Otherwise, Chimezie, you will come up again maybe in the next 1 or 2 years to come and discuss how the bettering NPL ratio may begin to worsen again. So now, it depends on actions taken by banks from now on, and we can discuss that.
Yeah, Mr. Udemezui, first of all, let's look at some of the sectors, that probably may have been contributing to this rising NPL, maybe in the past or perhaps in the future, just as you have mentioned. What are these sectors that you think are likely to pose a danger for the banking sector?
one of the major sectors that have thrown banks into very big shock and very big trouble, where they've had to do very huge provisioning, is the oil and gas sector. You know, that's a major, one of the most viable sectors of the economy, even though that sector contributes less than 10% of our GDP. But you find that because the transactions there are very sweet and very lucrative, big ticket transactions where banks can close deals and also have a lot of foreign exchange coming in. Banks tend to over-leverage themselves, overplay their hands in that sector whenever the going is good. And you find that whenever the oil price is nice and very bullish, that sector is doing well. Tank farms are springing up here and there. Oil exploration is going on very well. Oil servicing, and this sector demands high capital to operate. So you find banks lending extensively there. And once there's a shock there, like we had in 2016, and even though the OPEC Plus has tried to manage the law, bearish trend in prices, and that's why that sector is not doing so badly right now. But oil sector has contributed largely to banks' undoing in terms of non-performing loans. And again, looking back in the past when we had to do the hard behavior, whenever a sector tends to improve, banks tend to move there in a hard manner. Before 2008, 2009 financial crisis, banks had also got exposed heavily in the margin loan, giving loans for stock trading, and that also exposed them. That is not managing concentration risk very effectively. And of course, the manufacturing sector is a very large part of the Nigerian economy. And while banks are very scared and careful in lending to this SME in Nigeria, there are some companies that also have good big loans in that sector. So the manufacturing sector is another sector that many times throws banks into a big shock, because once the economy is not doing well, the manufacturing sector also begins to dwindle, in prosperity, and you find them struggling to pay back their loans, from manufacturing to cement to pharmaceutical, and of course, a few service industries are, players are also contributors. But the key contributors here usually are oil and gas, manufacturing, and the occasional time when we went into margin lending, in defiance to risk management framework that banks should have. So if we have time, we can discuss what can be done to strengthen the situation. And let me also remark, in commending the central bank, that part of the reason why we have seen the NPL ratio abating or getting better is because of also the global standing instruction now introduced in industry, whereby banks are now authorized to set off balances of customers, particularly those chronic debtors who will owe a bank and refuse to pay, while running balances, positive balances in other banks. Today, banks are having the power to now annex or take over such balances to settle debt. And this is a very big solution to chronic debt situation in Nigeria. And of course, the credit bureau system is also getting better. And of course, mind you, in a country where you don't have a strong credit bureau system, people will play the system. They borrow here, play games, and go to the other place and borrow. But once you have a very good credit bureau system where these people are exposed, then that resolves the problem. So this thing has helped already.
Yeah. All right, Mr. Udemeze, you did mention about you are a risk expert, and you did mention about the risks that the banks would have to watch out for, particularly as it concerns the forbearance that, was granted and all of that. So can you tell us, how do you think going into the new year that the banks will begin to, look at this and be able to manage some of these risks that are unforeseen, if I would put it that way?
Now, credit risk is so critical in banking. Most banks make a whole lot of their profit or revenue from the credit portfolio. And that's also where most of their risks come from. And whenever an economy is not doing well, many businesses are struggling and their loans are likely to go bad. And once they cannot meet up with payment plan and arrangement, you begin to get them classified as non-performing. So one, banks from the board, I must state this, because many times the key issues come from the way a bank is governed. Governance and risk management is very critical in this matter. Credit risk is one of the 4 major risks that can bring a bank down: market risk, credit risk, liquidity risk, and operational risk. And when credit risk is joined with operational risk, where staff or management or executives are not behaving well, a bank can fall overnight, no matter how big that bank is or how long it has run. So my advice is, one, banks must ensure they are properly run. Bank owners and shareholders or directors must not overplay their hands. They must not abuse the system. Insider abuse has been reported severally by Central Bank's audit, where several co-owners, directors of banks, owe the bank that they manage and they refuse to pay the same loan or take unnecessary big risk because they think that the money is free for them to use. And then the bank begins to struggle. And Central Bank in recent times have always frowned on such banks. You know, even a too big to fail bank, or what you call domestic systemically important bank, has recently failed or to polarize, even after acquiring another bank in just 1 year. That's the nature of what insider abuse can do to a bank. Then very importantly too, banks must take time to properly train and groom their people in their credit process in line with their standard credit policy, what you call a credit policy guide. Any bank that must survive credit risk must have a clear procedure. Approval processes must be streamlined. You know, how loans are documented, and secured, security perfection, and very importantly, capacity building not just in the hands of remedial managers, but people who are in the front line. But in the three-tier process of risk management, that's the three lines of defense model, the owners of the risk are the people who book these loans. They are, most times, I'm a trainer, and we train several banks in Africa. I'm doing that in Kenya right now. You find that many banks don't spend enough time to train their staff. And people don't know what to do when loans begin to get delinquent. And over time, and you find that there's a correlation, a positive correlation between capacity building and quality risk management. A number of banks in Nigeria are still below 5%. I can tell you that, but I'm not calling names. Some banks are doing 2%, 3% within the limit, while a whole others are doing 19%. Even in the midst of 6.5% we have now, I can tell you for free that some banks are somewhere around 15, 17%, which is very bad. And you find those banks not spending enough time and resources to prepare their people for the loan recovery or remedial or workout process. It's technical and also, soft in a way. So it's important that as we come into the new year, banks must sit back and proactively look at all the loans that have been affected by COVID. Yes, even though they have proactive forbearance allowed by CBN, very soon that period of forbearance will lapse, and those loans might begin to get classified as delinquent. And this figure we are enjoying today will get worse and not better. While we expect the limit to come between 5%, we may actually get worse in the next 1 or 2 years if banks don't do what they need to do in terms of credit risk governance and management.
We hope that doesn't get to that. Thank you very much, Mr. Udemezue, for sharing your thoughts there. It's always a pleasure.
Always my pleasure to join you, Chimezie. Thank you so much.